I'm Sebastian Mullins, Head of Multi-Asset and Fixed Income at Schroders Australia. Markets continue to rally throughout the quarter, with risk assets grinding higher. Equities delivered around 3% in local currency terms over the quarter. However, the quarter started off in a rocky tone. Equities in the US fell 5% in April, mainly because the US saw consecutive higher than expected inflation prints for 3 months in a row, causing bond yields to back up higher. The US 10-year yield approached 4.7%, and the US 2-year bond approached above 5%. That caused equity markets to fall. However, the following month, inflation came in line with expectations, and we started to see weaker than expected US growth data come through, which allowed the market to calm down and saw yields fall back down towards the lower end of those ranges, and allowed equities to rally over 10% from trough to peak, ending the quarter up over 4% in US dollar terms. The best performing equity market was actually emerging market equities for the quarter, because TSMC, the chip manufacturing company in Taiwan, rallied so strongly based on strong growth from companies like Nvidia who buy their chips in part of the process. That saw Taiwan equities rise 16% over the quarter in US dollar terms. The other upset during the quarter was the French elections, which surprised many when the EU Parliament saw a swing to the right, causing Macron and France to call snap elections. That caused equities, mainly in Europe, to fall, but also credit spreads to blow out in European IG, investment grade, and high yield credit. The spread between the France government bonds and the German government bonds blew out to a level not seen before since the Eurozone crisis. However, at the end of the month, markets calmed down and some of the spreads narrowed to the margin. Finally, US dollar had a strong month. It was up around 6% over the quarter because Japanese yen fell dramatically and the European currency euro also fell. However, Aussie dollars rallied around 2% against US dollars. The Schroder Real Return Fund wholesale class delivered 1% over the quarter net of fees, bringing the 1-year return net of fees to the end of June to 10%. Pretty much every asset class added to performance over the quarter, predominantly equities, which rallied strongly, but also Australian credit, securitized credit, and commodities. Duration detracted on the margin. However, where we put our allocation in duration did insulate the portfolio during a pretty volatile quarter for duration. The fund stayed at the front end of the curve in US and German duration, and the curve actually steepened during that time, so being in the front end benefited relative to being in the back end. And Australia, we had the opposite position on. We were long the further out part of the curve in Australia, and that curve actually flattened during the period, as higher than expected inflation in Australia, so the front end of the yield curve moved. So overall, our allocation within duration helped the portfolio, despite overall duration detracting over the quarter. On the margin, we also saw currencies detract, given the strong Australian dollar over the quarter, mainly because of our allocation to US dollars and Japanese yen. However, that only detracted on the margin, considering the strong performance we saw in asset classes throughout the rest of the portfolio. The outlook for global growth and risk assets remains supportive. If you think about the last couple of months, the US economy has been the strongest economy in the world, delivering most of the economic gains. We are seeing the US weaken on the margin, with economic surprises coming in below expectations over the past month or two. And that's not to say that we expect a recession in the US, but the US is slowing. But slowing from extremely hot, overheating economy to more of a normal, steady state. So for us, that's positive and supportive of the soft landing narrative. However, the rest of the world has been not in such a good spot. You've seen places like Europe and China and the rest of Asia really languishing over the past couple of months. However, we think this is going to change, with the rest of the world starting to catch up to the US, just as the US starts to slow on the margin. If you look at this slide on the left-hand side, we're showing global economic leading indicators, which look at economic conditions, and that leads global GDP by about 3 months. And you can see that's been ticking up quite strongly over the past few quarters, indicating we believe global growth will continue to pick up over the next few quarters. On the right-hand side, you can see some more trade data. Here I've used Sweden, which is a more open and trade-based economy. We've shown new orders minus inventories, suggesting that the global manufacturing cycle is likely to increase over time following that relationship. But the same relationship can be seen in places like Taiwan or other open economies based on trade. So we do believe global trade and that re-acceleration of growth in countries ex-US will help lead to a synchronized recovery globally. So the question is, why wasn't there a recession in the US? We saw interest rates rise to the highest level since the past 40 years, from around 0 to 5+%. Normally, an interest rate hike that high and that soon leads to cracks starting to appear. However, we've yet to see any cracks in the US economy. And that's because the US economy relies on 3 key pillars. And the first one is the consumer, and the second one is the corporate. Third one being the government, which I'll get to in a moment. But when it comes to the consumer, highest interest rates haven't actually affected them. Unlike Australia, we don't actually have much, the US doesn't have much of their debt linked to floating rate credit. So for example, only 11% of their debt is floating rate. That compares to 25% back in 2007 and around 40% in the 80s. So the increase in interest rates hasn't hurt them as much. In fact, most of their fixed mortgages in their mortgages, and that's been sort of around 7% right now in terms of all-in yield. However, most people lock their mortgages in between 3 and 4%. So they're not experiencing the high rate increases that other countries have with more floating rate debt. The best way to show this on the left-hand side is the household debt service payment as a percentage of disposable income. And you can see it's never been a better time to have debt in the past 40 years when you exclude that COVID distortion. So the consumer in aggregate is not cracking. The same is true on the right-hand side for corporates. Corporates actually delevered after the GFC, the global financial crisis in 2008, just like the households. And similarly, they locked in low levels or low yields of their debt during the 2020 and 2021 period. If you think about a company like Apple, they actually have more money sitting in their cash account earning 5% interest rates than they do in their debt accounts that they pay out less than that. So they're actually making more money on their interest on cash than they're paying out on their interest in debt. And that's true for around 35% of tech companies within the US equity market. So on the right-hand side, another way to show that is non-financial corporate net interest expense. That's how much they pay on interest minus how much they receive in cash. And again, it's one of the best in about 10 years. So the corporate and the household have delevered and locked in low levels of fixed debt. So the real person or the pillar I should say, who's suffering is the US government. The US government is seeing their interest expense balloon, and now interest expense is larger than defense and Medicare. So the real person who needs interest rates to be lower is the US government. So with that outlook, with the corporates being fine and the consumer being fine and the economy is chugging along, we do believe it's a supportive backdrop for growth. That said, if you look on the next slide, US equities on the left-hand side are quite expensive. In fact, they're the most expensive equity market out there right now compared to others, but also compared to their own history. You can see a 26 times price to earnings ratio that is quite above the rest of the pack. We do believe there are reasons for that. They have the highest quality of earnings. Earnings expectations continue to rise and be strong, and they benefit from monopoly power for most of the tech companies that the world relies on. So we do think they are expensive, but we're not expecting a crash imminently. We prefer to be in US equities with put protection, which is very cheap right now, than selling outright. That said, the rest of the world looks around average. Now that's kind of positive because on the right-hand side you can see our model, which is our forward-looking top-down macroeconomic global EPS or earnings per share growth model. Suggests that earnings should continue to rise over the next coming year. So if earnings continue to surprise on the upside, valuation should improve as those companies earn their way into their valuations. So overall, we prefer to move away from the US now into other cheaper markets like Europe, like Japan. However, we don't want to exit the US just yet and instead prefer to buy put protection on those expensive equity markets like the US. Within credits, we do actually think that most credit markets are looking quite expensive now. When assessing credits, you have to think about what is the spread or the yield above government bonds. Depending how wide that is or how narrow that is tells you if credit is expensive or cheap. Right now, spreads in the US credit market, both in investment grade and high yield, are quite tight, towards the, say, 20th to 30th percentile in terms of tightness. For us, that's not as attractive as other markets. You can see here, long story short, red is expensive, green is cheap. The few assets that remain in the neutral zone are European credits, Australian credits, and also US securitized credits. So for us, we prefer to rotate away from the more expensive US credit markets towards Europe and Australia, and also towards securitized markets, which still show some pretty good value relative to credit. For example, US mortgages or agency-backed mortgages pay around 1.2% above the government rate, so a spread of about 120 basis points over, whereas corporate bonds are giving around the same thing. One is AAA, government guaranteed, the other one is around BBB. So one is highly higher quality, more secure from default, and paying you slightly more than the corporate credit. So for us, trying to find this pocket of opportunities within credit is the best solution for us while we allocate between different asset classes. We continue to lean into the risk rally right now by having around 36 to 37% in equities in delta adjusted terms. Our cash position remains low at around 4%, and we do look to deploy that cash when we see opportunities arise. The rest of the portfolio is diversified across higher yielding and investment grade credit, where we find opportunities and valuations. We have been moving the asset allocation around during the quarter. When we saw the market sell off in April, at the beginning of the quarter, we had around 2.5% into equities as the market fell. And towards the end of the quarter, we actually rolled up our put options rather than selling equities to maintain a sustained level of risk in equities over the quarter at around 37%. We do have put options and call options in the portfolio. So if the market continues to rally, we should see our equity weight rise to around 40%. And if the market sells off in a correction of around 10% or more, our equity position will fall down to around 25%. So keeping asymmetry in our risk profile. Towards the end of the quarter, we sold some US equities, around 2%, and allocated back to European equities, given the sell-off we saw after the French election news. And we also used that as an opportunity to start selling some of our public equities to make an allocation into private equity. We allocated around 2% to our semi-liquid private equity fund, managed by Schroders, which typically is a small to mid-cap play in the private equity space. We like that allocation because it has a price-to-earnings ratio of around 10% or less, which is very favorable compared to, say, the Russell 2000, which is the US small cap index, which has a PE ratio of around 27 times now. So we like the allocation because it gives us access to cheap, small and mid-cap companies, the expectation to grow those companies and benefit from the small company effect as we hold that position over time. We also used the sell-off in credits after the French elections to buy more credits. We added around 2% to European high yield, where spreads widened dramatically after the French election news. And we also added to European investment grade credit, but that was funded by selling Australian investment grade credit. So using the volatility in Europe to allocate towards Europe, given our more structural view that the economy is improving and recovering compared to where it was in the past. When it comes to currencies, we did add to Australian dollars. We do believe that the RBA is in a bind and will not be able to cut rates like the rest of central banks and might even be forced to hike in the next couple of months. For that reason, we want to have more exposure to Australian dollars, and we did that by selling more European currency, the euro, and also this Japanese yen, JPY. When it came to duration, we saw yields move quite dramatically over the quarter. When yields backed up aggressively, we actually added around a quarter of a year to duration in the US 5-year futures. And then as yields came back down again, we actually took profit on that allocation. We also sold quite a lot of our Australian duration before the surprise inflation print, which helped the fund as those yields spiked out towards the end of the quarter on that surprise inflation news. Where we were invested within duration really helped the portfolio. We prefer having steepeners, which means long the front end and have less in the back end in places like the US and Europe. But we have a flattener on in Australia, which means we don't have much exposure in the front end and have most of our exposure out in the back end. As well, we used our inflation protection, our US inflation-linked bond allocation. We sold around 2% of that to buy 2% Australian inflation-linked protection. At the time, the break-evens on those in Australia was around 2.3%, which means inflation has to be above that for the allocation to work better than bonds. And of course, that is below the RBA's target of 2.5%. So we believe that was a good allocation to have in the portfolio to protect us from any surprise in inflation, which of course came through towards the end of the quarter. So for now, we're leaning into risk, have inflation protection in the portfolio, and using cash to allocate more to risk if we see a wobble. But in the meantime, holding levels of duration around 2.25 years and keeping equities around 37%.